Hello, this is Strictly Money, and I'm your host, Saijal Patel. Thanks for joining. If you're a business owner who finds it hard to plan for retirement or even keep key executives, then an individual pension plan or IPP might be for you. Tens of thousands of Canadian entrepreneurs have set up IPPs as an alternative to an RRSP to save for their retirement and cut their tax bill. Joining me now to discuss what you need to know about them is tax strategist and consultant Trevor Parry. Trevor, great to have you on.
Hi, great to see you today.
So IPPs, these individual pension plans, they've been around for a while. I'd say they're probably not as familiar as other retirement plans. So how do you describe what they are?
Well, they've been around since 1991. They came into existence after a couple of iterations. It was the first time that a business owner could actually be part of a pension plan. The uptake on them was not big, and it still isn't. There's only, I guess, about 15,000 plans. And a lot of that is governed by the prevailing tax situation. When I was in the actuarial world, I was the national sales director for a boutique actuarial firm. We had the honor to have set up the most in Canada, about 2,200 of them. So we saw all kinds of scenarios where they do work. And they continue to work, both for tax reasons, but moreover for planning reasons. I think they're sort of like the big heavy blanket that people like when we look at the safety that a pension plan provides.
So, as you said, it's meant for incorporated business owners and their executives. But Trevor, obviously, it's not for everyone, right? Not everyone fits the bill. So,
No, and I wouldn't even include. So technically, they're called connected employees. So somebody who owns
okay,
10% of the voting shares. I wouldn't include your senior executives in an IPP unless you are prepared to fund it, because it's a technical thing. But
hmm
most of the provinces, following the lead of Quebec, Alberta, and British Columbia, have adopted rules that for shareholder plans, you can opt out of provincial regulation and not have to fund them. So you never have a GM or Chrysler problem. That doesn't happen with a normal employee. You're on the hook for the whole amount.
And my understanding is it's ideal for those who are mid 40s.
More than that, I
Okay,
wouldn't
why is
probably
that?
start. Well, most of the plans, overwhelmingly, probably 99% of them are defined benefit plans. And a defined benefit plan has a larger contribution based on the time you have to fund it. So the older you are, the bigger the deposit. So we would routinely look at these. We might look at mid 40s, but I think the sweet spot is early 50s,
Okay.
because you'll have the service to get a nice big past service deduction and considerably larger contributions than you otherwise would have had to an RSP.
Right, because an RSP is based, it's 18% of your previous year's income. And how do the numbers work, Trevor, as you
Oh,
get
with
into the 50s? It's
well,
above that.
you're oh yeah, considerably. Usually, on an annual basis, probably $10,000 more than what an RSP will allow. But it's the past service that particularly the accountants focus on. It's like if you ever had anybody who worked in government, they talk about buyback credits. It's a similar
hmm
situation. You can
Okay.
go back and in essence fund the difference between what you could have put into an RSP and an IPP for the time you've worked for your own company. And that's routinely hundreds of thousands of dollars, particularly when we get out into sort of pre-departure or pre-retirement planning or exit planning for entrepreneurs. It's not unusual to create $1 million deductions.
All right. Yeah. And that's definitely a pro. So, for those who are watching, I'm sure there's a lot of people thinking, you know what? Why don't I just stick to an RSP and a CPP? Does that still make
And some
sense?
should. Some should. I find now that in many cases it depends on uh, the planning need, because there are some who simply need to have a nice set of handcuffs put on, usually incorporated doctors. They're terrible at saving money for them to paint with a wide brush.
Yeah.
But from a pure tax analysis, if you're in the top tax bracket, and remember that's anything north of 220 in Ontario, you're paying 53.53%.
Right.
Um, you're better off with an RSP because the deduction is occurring arguably at 53.53%. Whereas if you're in a business that's paying the small business rate, your deduction's at 12.3%. You're better off with an RSP.
Okay. We only have about 20 seconds left. And could you use both then, RSP? Or
No,
I'm assuming
no,
contribution
you
room,
can't.
it uses it up, right? So you can't.
Yeah, you get what's called a pension adjustment. You can do what's called a retirement compensation arrangement with an
Mhm.
RSP, and we usually did those and still do those for folks who are very successful but too young for an IPP.
Okay, we're going to take a quick break and we'll continue this conversation when we come back. Welcome back. Trevor, just before the break, you were talking about the retirement compensation arrangement. Please continue and
It's
explain
not
what
a
that is.
television
Yeah,
called an RCA.
RCA.
Uh, we did, a few hundred of them when I was with the actuarial firm, and I still use them in the course of planning for a variety of reasons. They're more there's more latitude in planning than there would be with a pension plan, and as I said, they don't create a pension adjustment. So if you had somebody, let's say, earning several $100,000, they own their own company, they're maybe a young tech person, they're better off from a pure tax perspective and from a pension perspective to use the RSP for their primary registered plan. But if they need further retirement savings and corporate deductions, in 86 the government introduced the retirement compensation arrangement rules. Now they're still used as a nasty remedy if you try to set up the wrong thing, but in essence it allows a company to fund a supplemental pension benefit. So Canadian pension rules or pension limits are woefully behind the United States and our principal European trading partners. So if we wanted to create that pension equalization, we use an RCA. And an RCA is a funded trust where half of the money is invested and the other half of the deposit is held in refundable tax with CRA and then paid back when withdrawals happen. The advantages of it is that there are no age 71 rules. So you can take it out in your 80s or your 60s. It's loss of office that triggers the ability to take the money out. And it's particularly useful for severances, so executive severance, where you want to try to avoid having that lump sum, or the real tangible use, and there's a lot of that going on right now, is pre-departure planning. People who don't intend to be in Canada for whatever reason,
Okay.
we take it out, collapse it, and they pay what's called Part 13 tax,
Yeah.
which is 15 to 25%. And if you structure things correctly, that's the end of it.
Okay.
Hence, the NHL players in Canada use them in a profligate fashion.
Makes sense. Makes sense. Trevor, so for those who are watching and thinking about setting up an IPP, where do they start?
Speak to your financial advisor, and they'll know to call usually an actuarial consulting firm. You want someone who will come out and meet with you and go through the analysis. They will prepare an illustration for you, but also know where it works. If you're, 28 years old, you shouldn't be talking about an IPP. There's
Mhm.
something else.
Yeah.
If you're 63 and you're thinking about trying to sell the business, you and the spouse have been on the books for a while, then you certainly want to look at one of these things. But sort of understand contextually in an objective fashion where you are in terms of the life cycle of your business, what your tax needs are, what your future tax needs are, and what does retirement look like for you.
Be-
Um,
Yeah, and I was going to say, Trevor, because the people who are involved in this, I mean, the advisor has to work with the actuary. Advisor is often used as a broad term. So would you say the advisor has to have certain qualifications and skills?
One would hope that they've done a few and they have some battlefield experience. Most don't because there's only 15,000.
Mhm.
What you want to be able to do is hopefully the advisor is a good listener and knows to stand aside and certainly have their client's interest and ask the right questions. But try not to, the worst thing is where we used to have to try to train the advisor to go out and answer the questions that we had 1,000 times.
Yeah.
Involve the actuary because most of them have field people who go in and help. And then often it's the actuary themselves who will go out into the field and answer those questions and liaison with the accountant. Lawyers are very rarely involved in these things. They're pretty, canned in terms of what the documentation looks like. But getting the accountant to understand, because you always look to your accountant as sort of this oracle of Delphi when it comes to tax, and the vast majority of them are not tax specialists. They have taken courses in this kind of stuff, but their knowledge of IPPs is usually limited to having attended a 2-hour seminar. So there's not a
Okay.
lot of battlefield experience.
Yeah. what are the numbers we're looking at? And because I assume a lot of people are going to say, "Oh, that's a deterrent," and there's
Sure.
considerations, right? There's benefits, and that might
Yeah.
outweigh the cost.
Usually, I would think they're probably about $1,500 a year
Okay.
to keep going. Now, remember, in provinces that have payroll taxes, so Ontario, most of them do, the contributions don't attract that payroll tax, so there's a savings. And your management fees, investment management fees, as are your actuarial and pension management fees, are fully deductible. So again, what's the corporate tax rate? So it does reduce, but yeah, there's a fee. It's more expensive than operating an RRSP, but in the right situation, I think it makes a lot of sense. Particularly, I mean, as I said, the entrepreneur who's 63 and we get them a $1.4 million deduction
Hmm.
on day one. The setup fees and the professional fees are minimal.
Okay. We'll take a quick break, and we'll be back in two. Welcome back to Strictly Money. I'm here with Trevor Parry talking about IPPs, or individual pension plans. Trevor, let's run through some of the what ifs, right? So, what if you have irregular business income, which I think is common for a lot of entrepreneurs? Would an IPP make sense?
I think they should look at it, but again, it's a question. There's some planning issues, some behavioral issues. Are they good savers? What does exit look like? If the plan is to, if it's a stable cash flow business, and they are paying, the higher rate of corporate tax, maybe an IPP makes sense. Where I see it particularly making sense is as part of an exit strategy. So you have a family-held business, or entrepreneurs created a wonderful enterprise, and they decide in their early 60s that they're going to shop the thing. Well, an IPP can make tremendous sense because we're going to create these large past service contribution deductions of upward of $1 million. So
Hmm.
it helps, purify the corporation, and definitely create some wonderful tax advantages. With the what if, where I see from a pure planning perspective, I talked about it earlier. I think medical doctors who are incorporated should be looking at this because they get into the workforce later than everybody else. So it does allow them to catch up in terms of savings. And too many doctors that I've seen, again, to paint with a wide brush, are not financially savvy. They spend too much money. They get into financial difficulty. The IPP is like I said, it's a big warm blanket. It's a nice set of handcuffs that results in something. So if they're of the mentality where a pension makes sense, then put this on the table, because all this really is the teacher's pension plan for an entrepreneur or a professional. So I think it makes sense there. But there are other structures that work. I mean, an RSP, in my opinion, is probably for the vast majority of entrepreneurs and professionals a better structure from a tax perspective.
Yeah.
Using corporately held insurance can work if you understand how to do that. That's the old London Life Freedom 55 model. It still
Mhm.
works, particularly in an escalating interest rate environment.
Okay. We did bring up a board on what you do upon retirement. So you have a couple of options with your IPPs, right? Annuity,
Right.
you can take the whole
Yeah,
thing.
no, nobody does the annuity. I mean,
Yeah.
there's reason to look at it, particularly again with interest rates going up.
Mhm.
A lot of them turn it off, and that results in the plan wind up, and it kicks out a huge tax bill. And the government brought in measures a couple of years ago that make it extremely difficult, if not possible, to transfer your plan. Because you used to see that where they would set up a plan and move it over, and there was a lot of bogus planning. There's court cases on it, but that's been shut down. The CRA and the Department of Finance tends to do surgery with a sledgehammer when they see abusive use. So that
Okay.
was all about.
Okay.
But or you keep it going. And we find that particularly with professional corps, particularly dental corps, they may sell the dental corporation. You want to
Mhm.
have an eye towards that because you can move. You just simply have two sponsors, a sister co and the DPC, the Dental Professional Corp. And in essence, and I'm summarizing, the original plan sponsor falls off after a period of time, and the new company just continues as we're sponsoring the plan.
Okay.
So they're flexible.
Okay. Trevor, we have less than 2 minutes until the next break. I want to talk about PPPs. This is personal pension plans because it's been touted as an alternative to IPPs with more
A lot
flexibility.
of things. Yeah.
What are your thoughts on PPPs?
They're an IPP with a trademark on them, and that they are
Okay.
being marketed as a solution for a problem that does not exist. They were introduced, they're called hybrid plans, and they've been
Yeah.
around in one form or another for years. And the company that markets them did not create a hybrid plan. And it allowed the plan to switch between defined benefit and defined contribution. And the reason you had that was because if you got into a funding problem under the old rules, you had to either fund it or look to the provincial legislation. It's Rule 48 in Ontario that would allow you to rewrite the benefit formula. So there was always a safety valve in provincial legislation to prevent a funding problem. So the GM Chrysler problem was never going to happen. But the PPP was introduced saying, okay, well, you can switch to DC or you can do this or do that. Well, Ontario amended the rules when the Ford government came in. So there's no required funding for a shareholder or a connected person plan. So their entire raison d'etre is academic, it doesn't exist. And I see it marketed into some pretty aggressive situations, like telling the business owner to put their kids or their grandkids in at a nominal salary so they can create a roll down of pension assets. Well, anyone who has any understanding of family law understands that a divorce is going to probably create some problem with the pension assets being attacked. And for insomnia cure, go and read Canada Trust Co on the three-prong test for GAR, because I think that what's being marketed fulfills checks all three boxes.
Okay, thanks for that clarification. We're going to take a quick break, and we'll be back. Welcome back. Trevor, I talk a lot about retirement and retirement options on my show. And part of the reason is I know retirement planning, as you know, is tough. And frankly, a lot of people don't do it and they procrastinate. As a tax strategist, how would you assess the retirement preparedness of Canadians? Because you must see a lot.
Woeful. Would be too many people don't take it seriously. The people that do often don't have the means. There's a lot of panic, particularly in increasing interest rate environment.
Yeah.
Some are good planners. Some folks are just hardwired that way, and that's great. There's 15,000 IPPs, so 15,000 people have taken correct steps to make concrete plans for retirement. But I would say the vast majority of planning is not utilized. People live too often paycheck to paycheck. There's a great deal of trepidation in entrepreneurial markets right now, given what the current federal government is doing in terms of promoting business and taxing everything in sight.
Mm-hmm.
Fear of a wealth tax is a terrible specter. I mean, that's why you're getting mass flows of capital out of the country. That and seizing bank accounts wasn't a good thing for the international market. So there's a lot of fear. And again, the provincial government's promoting financial literacy and education. That's a good first step. But the folks who are close to retirement haven't done it. They're not literate on these issues. Most people don't plug their RSP.
Yeah.
So it's not a good thing. And you haven't, like, in a weird way, in an economic way, increasing interest rates is good to an extent, because now you're going to get a safe savings rate. I would argue, and I'm not an economist, but read them from time to time, that 30 years of near zero or low, of perpetually low interest rates hollowed out the middle class like nothing else.
Yeah.
So maybe a reasonable interest rate for a prolonged period of time readjusts things economically so that people are saving, and then they are thinking about retirement. But I think a lot of folks are going to work until they're shuffling off the mortal coil. And retirement, maybe it's partial retirement, maybe it's just longer vacations. And that has to do more with workplace environments, what we do in the gig economy and all that kind of stuff.
I was just going to mention the gig economy. We only have about 2 minutes, but what would you like to see that you think would help retirees? Is it more options or less complicated options?
I would like people to have more money. And
I agree with you there.
To quote Conrad Black, short of war, there's no moral justification for the state to take more than half of what someone makes. So if you put money back in people's hands, you're going to have all kinds of wonderful things, including a more philanthropic society. We need to realize that some people are going to retire, some aren't. Some need tax relief, some don't. RSP rates or contribution rates should be increased, as should pension rates should be
Yeah, you
increased.
mentioned pension limitations or the pension contributions are lower than other countries.
Yeah, they are.
Here.
They can noticeably, but given the current ideological, zealotry of the current federal government, it's not going to happen. You have them and this is what bothers me. I'm 55 years old. I remember the first Trudeau, and even he did not run around promulgating policy on the basis of class envy. It's not a good thing. It's un-Canadian. And that's exactly what this government is doing. They're going off and saying the 1%. Well, go and do the research as to what the 1% is in Canada. It's not that much money. I think it's about $180,000 a year. It's well off from what the US 1% is. It's really the middle class that he's targeting. And how can he retire if he's looking at that as the great cash cow?
Yeah, and 1% in the high tax bracket, when you look at it, or what they consider high tax bracket has changed in today's
Oh, I know.
environment.
But when you travel in the United States and talk to somebody about like even California, which is taxed as high rate as we are, but it doesn't kick into 400 or 500,000. The Americans are just they don't know about Canada for the most part. But you tell them that, staggered.
And they are.
Uh,
I really
under
I appreciate. We're sorry, we're out of time, Trevor, but I really appreciate you coming on, and we'll have to get you back.
Thank you very much. This
Trevor
was
Parry.
wonderful.
Trevor Parry, TRP of TRP Strategy Group. Well, that does it for this show. Do you have a story you'd like to share or questions about this or previous shows? If so, please drop us an email. Thanks for watching. Until next time, stay well, stay wise, and stay wealthy.